The year 1929 is synonymous with one thing: the stock market crash. How did it happen? Why was it so severe? The people of the 1920s were so conditioned to new highs and strong bull markets that they genuinely believed the good times would not end. Yale economist Irving Fisher was one of the most respected authorities at the time, and was not alone in believing good times were here to stay. So how did things get so bad so very quickly? Since its establishment in 1913, the Federal Reserve has been tasked with determining the monetary policy of the United States of America. The Fed sets the discount rate at which banks can borrow money. Low interest rates tend to help the stock market, as people are more inclined to buy stocks than bonds, which will have lower yields. As the Fed raises interest rates, stocks tend to be viewed as more risky, as bonds with their higher yields become more attractive. From 1921 to 1928, low interest rates helped propel the Dow Jones Industrial Average to new highs. The Roaring '20s were an exciting time to be alive, as new technologies and easy credit helped make life much easier for those who had suffered so much during World War I. As the market continued higher, more and more people became interested in trading stocks. After all, it seemed like an easy way to make money. The stock market even became part of pop culture.
I'll have to see my broker, find out what he can do, 'cause I'm in the market for you.
It seemed like everyone was fascinated by stocks at this time. Leverage was a big part of that fascination. For only $10 down, you could control $100 worth of stock. This 10-to-1 leverage wasn't seen as risky, since the market had been on such a torrent run and no one could possibly see it falling. Americans had gotten used to buying on credit, as Henry Ford had sold his Model Ts with installment plans, allowing the average individual to purchase an automobile for the first time. It seemed like the good times were never going to end. Speculation was getting out of hand though. It seemed like everyone was out to get rich quick, and stocks were seen as the best bet in town. People began to pour their life savings into the market, hoping to catch an easy buck. As the fall began to roll around, the Fed decided to raise interest rates by 1%. The average person did not care, as euphoria ran through the markets. Leading economists believed the United States had reached a new level of prosperity. The average person became extremely confident in their stock-picking abilities, but the seasoned traders knew there was trouble ahead. Upon getting his shoe shined in the late summer of 1929, Joseph P. Kennedy, father of future President John F. Kennedy, had a memorable encounter with a young boy. As he shined his shoes, the young lad began to advise Kennedy on what stocks to buy. After Kennedy thanked him, he immediately ran to a telephone to notify his broker to sell all of his positions. "What are you doing?" exclaimed his broker. Kennedy replied that when the shoeshine boy starts telling me what to buy, that's the time to exit. Confidence was beginning to fade, and soon it would turn to panic. Black Thursday, October 24th, 1929. The market broke hard as heavy selling came flooding in. The stock tickers kept running hours after the markets closed, as they just could not handle the flurry of activity. By midday, the market was down over 10%, and the leading bankers met to discuss what to do. In an effort to soothe the market, like J.P. Morgan had done during the panic of 1907, the decision was made for swift and striking action. Richard Whitney, president of the New York Stock Exchange, walked boldly onto the trading floor and placed large buying orders far above the current bid prices on many leading stocks in hope of bottoming the market. Buoyed by Whitney's actions, the Dow Jones rose until the close. The uptrend, however, was short-lived. Over the weekend, more and more people realized they needed to get out of the market, and there was a stampede of selling on Monday, October 28th, 1929, which would later be known as Black Monday. As stocks dropped, brokers began to make margin calls. Because people had bought on credit, they now had to either add more money to their account to maintain their positions or sell their stocks at a massive loss. Without any more money left, people were forced to sell, which in turn led to more selling. There simply was no buying coming into the market. Everyone wanted out. At the end of the day, the market was down over 12% on Black Monday alone. The massacre continued the next day as stocks continued to slide. Down another 10%, the Dow Jones Industrial Average was in shambles, and the nation in shock. With the market down over 22% in just 2 days, fortunes were lost as Americans and the world came to grips with a stock market crash that they were severely not ready for. The bear market would continue until 1932, as the Dow Jones Industrial Average would decline over 85%, and the world would enter the Great Depression.